Hello guys, welcome back to our channel Shortcut Guru, where we will be helping you to solve UPSC Civil Services Prelims examinations questions through elimination techniques and guide you through your UPSC journey. We have started a new series, and in this series we will be solving questions topic wise. In this video, we will be solving questions from the topic Money and Banking from Economics. Let's begin with a question from the year 2010, and the question goes: when the Reserve Bank of India announces an increase of the cash reserve ratio, what does it mean? Statement A. The commercial banks will have less money to lend. B. The Reserve Bank of India will have less money to lend. C. The Union government will have less money to lend. D. The commercial banks will have more money to lend. To solve this question, we must first know what a cash reserve ratio is. CRR, or the cash reserve ratio, is the percentage of cash required to be kept in reserve as against the bank's total deposits. The cash reserve is either stored in the bank's vault or is sent to the RBI, and an increase in CRR means that the commercial banks will have to maintain a higher percentage of their deposits as reserve with the RBI, which leaves the bank with less money to lend, which in turn reduces the availability of credit in the economy. And here the right answer is option A. The commercial banks will have less money to lend. Moving to the next question: which of the following is treated as artificial currency? Option A, ADR, B, GDR, C, SDR, and D, both ADR and SDR. The expanded form of ADR is American Depository Receipt, and that of GDR is Global Depository Receipt. And these are examples of depository receipt, which is a negotiable certificate issued by a bank and represent as in a foreign company traded on a local stock exchange. An SDR, or special drawing right, can be thought as an artificial currency created by IMF. It is not a physical currency, but a basket of currencies consisting of the US dollar, euro, Japanese yen, British pound sterling, and Chinese renminbi. And the right answer is option C, SDR. Moving to the next question: in the context of Indian economy, open market operations refers to option A, borrowing by scheduled banks from the RBI, option B, lending by commercial banks to industry and trade, option C, purchase and sale of government securities by the RBI, and option D, none of the above. Open market operations refers to the purchase and sale of government securities by the Reserve Bank of India. It helps RBI to control recession, inflation, etc. And the right answer is option C, purchase and sale of government securities by the RBI. Moving to the next question: the terms marginal standing facility rate and net demand and time liabilities, sometimes appearing in news, are used in relation to option A, banking operations, option B, communication networking, option C, military strategies, option D, supply and demand of agricultural products. Marginal standing facility rate and net demand and time liabilities are financial terms and are not associated with communication, military strategies, or agriculture. So option B, C, and D can be easily eliminated. Marginal standing facility rate is the rate at which scheduled banks can borrow funds overnight from RBI against government securities. The rate is typically higher than the repo rate. Net demand and time liabilities is the total amount of deposits a bank holds. It is used to calculate various requirements including the CRR and the SLR. And here the right answer is option A, banking operations. Moving to the next question: the Reserve Bank of India acts as a banker's bank. This would imply which of the following? Statement 1, other banks retain their deposits with the RBI. Statement 2, the RBI lends funds to the commercial banks in times of need. Statement 3, the RBI advises the commercial banks on monetary matters. Select the correct answer using the codes given below. In simple terms, a banker's bank acts as a bank for other banks. The three statements come under the banking services provided by the RBI to the other banks. And here the right answer is option D, 1, 2, and 3. Moving to the next question: which one of the following best describes the term merchant discount rate, sometimes seen in news? Option A, the incentive given by a bank to a merchant for accepting payments through debit cards pertaining to that bank. Option B, the amount paid back by banks to their customers when they use debit cards for financial transactions for purchasing goods or services. Option C, the charge to a merchant by a bank for accepting payments from his customers through the bank's debit cards. Option D. The incentive given by the government to merchants for promoting digital payments by their customers through point-of-sale machines and debit card. Here, you will be able to solve this question if you know that merchant discount rate is a fee charged to the merchant and not an incentive given to them. The right answer here is option C, the charge to a merchant by a bank for accepting payments from his customers through the bank's debit cards. Let's see what is merchant discount rate. Merchant discount rate is a fee that merchants have to pay to banks or payment service providers when a customer uses a debit or credit card to make a payment. This fee covers the cost associated with the transaction, including processing and security. Moving to the next question. With reference to digital payments, consider the following statements. Statement 1. Bhim app allows the user to transfer money to anyone with a UPI-enabled bank account. Statement 1 is true. Coming to statement 2. While a chip-in debit card has 4 factors of authentication, Bhim app has only 2 factors of authentication. In this statement, there are 2 parts, and the first part is wrong. The chip-in enabled debit card has only 2 factors of authentication. That is the card itself and the PIN, that is personal identification number. And part 2 of the statement, Bhim app also has 2 factors of authentication is true, and the 2 factors are the mobile number linked to the bank account and the UPI PIN. And the right answer here is option A, 1 only. Moving to the next question. Which one of the following links all the ATMs in India? Option A, Indian Banks Association. Option B, National Securities Depository Limited. Option C, National Payments Corporation of India. And option D, Reserve Bank of India. Let's learn the option in detail and then eliminate the wrong options. The Indian Banks Association, or the IBA, is an industry body that represents the interests of banks in India. It is not responsible for linking all ATMs in the country. And NSDL is involved in the securities market, primarily handling the dematerialization of shares and securities. NPCI operates the National Financial Switch, which interconnects all ATMs in India. And the RBI regulates the banking system, including policy formulation and supervision. It does not directly manage the interconnections of ATM. And the most suitable answer here is NPCI. Moving to the next question. Consider the following statements. Statement 1. Capital adequacy ratio is the amount that banks have to maintain in the form of their own funds to offset any loss that banks incur if the account holders fail to repay dues, which is true. And statement 2, CAR, or the capital adequacy ratio, is decided by each individual bank, is not true. CAR, or the capital adequacy ratio, is set by financial regulators and RBI in the case of India. And here the right answer is option A, 1 only. Capital adequacy ratio is like a safety net for banks. It tells us how much money a bank needs to keep aside to handle any losses if people who borrowed money from the bank can't pay it back. Moving to the next question. The chairman of public sector banks are selected by option A, Banks Board Bureau, option B, Reserve Bank of India, option C, Union Ministry of Finance, and option D, Management of Concerned Bank. This question was asked in the year 2019. And here the right answer is option A, Banks Board Bureau. But at present, the Banks Board Bureau does not exist. It was replaced by the Financial Services Institutions Bureau in the year 2022. The Financial Services Institution Bureau, or the FSIB, not only covers public sector banks but also includes financial institutions and insurance companies. This expansion aims to streamline the appointment process for top positions across various financial entities. Moving to the next question. Consider the following statement. The Reserve Bank of India's recent directives relating to storage of payment system data, popularly known as Data Diktat, command the payment system providers that, Statement 1, they shall ensure that entire data relating to payment systems operated by them are stored in a system only in India. This statement is true. Statement 2, they shall ensure that the systems are owned and operated by public sector enterprises. Option 2 is incorrect. The RBI directive does not require that the systems be owned and operated by public sector enterprises. This statement can be eliminated. And statement 3, they shall submit the consolidated system audit report to the Comptroller and Auditor General of India by the end of the calendar year. Option 3 is wrong. The system providers must submit a system audit report conducted by CERTIN, certain empaneled auditors, to the RBI by the end of the calendar year. And here the right answer is option A, one only. Thank you.